Good day to all of you. Welcome to ODL session. This is Indian Economy class, week 8, lecture 5. Let us get into the class. Today, what we are going to discuss is how the fiscal policy and monetary policy are differing each other. For that, we should know what are the types of monetary policy and we should know what are the types of fiscal policy. This is coming under the poverty elevation program. How this macroeconomic policy helpful to eradicate the poverty. So, this is the concept that we are going to discuss today. First, we understand what is monetary policy is. The monetary policy refers to the central bank activities that are directed towards influencing the quantity of money, that is supply of money and the credit in the economy. This is the monetary side. On contrast, the fiscal policy refers to the government decision about the taxation and spending. It's related with the public revenue or public expenditure or public debt. So this is the main difference. So let us discuss elaborately about how this monetary policy differs from fiscal policy. We'll start with the main points and then we will elaborate in the later slides. How it differs with the objectives. What is the objective of monetary policy? To maintain the price stability, to achieve full employment and to improve the economic growth. These are all the objectives. Then coming to this side, the fiscal policy objective is to change the aggregate demand, how to control the inflation, how to overcome recession, how to control the economic activities. This is the objective of the fiscal policy. Let us move to the second one. What it does. The monetary policy mainly regulates the money supply and the cost by regulating the credit. It also influences the borrowing rate of the commercial bank. This is the monetary policy side. Then coming to fiscal policy side, the fiscal policy causes a deliberate change in the government revenue as well as government expenditure, that is public revenue and public expenditure, with a view to influence the price level in order to maintain the price level and the quantum of the national output. So this is the basic difference between the monetary policy and the fiscal policy. Both the monetary policy and fiscal policy are macroeconomic instruments that are available in different arms of the government. Though both are formulated and implemented by the same government, they are doing different activities. It is implemented through different ministries. It is implemented through different departments. The monetary policy implemented by the Reserve Bank of India, but fiscal policy through the Ministry of Finance. But they are interrelated, but this is the way the government is implementing these two macroeconomic policies. Let us elaborate the difference between monetary policy and fiscal policy. The main tool of these two policies are, for monetary policy, interest rate is the key factor. For fiscal policy, tax and government spending. What is the effect made out of these two? In case of monetary policy, the cost of borrowing and the mortgages. These are the effect made through monetary policy. What is a cost for doing a fiscal budget or fiscal policy in order to augment the budget deficit? How it is distributed? The higher rate of interest hits the home owners but it will benefit the saver. So it will increase the saving habit and in turn it will reach the investment. This is for the monetary side. For fiscal side, it depends on tax that you raise. The next factor that we are going to differentiate monetary policy and fiscal policy is the exchange rate. Higher the interest rate causes appreciation. But here, no effect for exchange rate. There is no connection between the exchange rate and the fiscal policy. Then, when we discuss about the supply side of money from the any economy, definitely it is a limited impact of monetary policy because it talks only about the money. It will not give about the what is the production, how much increase. All these things will not be discussed. But in case of fiscal policy, the high tax may affect the incentive of the work, and people will be controlled through fiscal policy based on the economic situation, recession, depression, inflation, deflationary. Based on that, the fiscal policy will change the tax rate and control the supply side. Then, of course, what is the influence of politics? The monetary policy is set independent of central bank. Nobody can touch that. But in case of fiscal policy, it is in the hands of politicians. Changing tax, government spending, highly political. Uh, Only the ruling party will decide this will be. When you got the majority, whatever they said, that will be the final. But in case of monetary policy, it is not possible. It is in the hands of the central government. But this is in the hands of the ruling government. So politicians play a dominant role in the fiscal policy. Last one is liquidity trap. This is a good economic answer. The monetary policy cuts the interest rate may not work in the liquidity trap because liquidity trap is the what are the need to keep money with them. There are three motives like transaction precautionary and speculative motive. There where the liquidity fails, where there is a gap, these things the monetary policy cannot do anything. It may cut the interest rate, but whether it works out, it depends upon how the people behave. But this is very useful tool for fiscal policy as whenever there is a recession, this concept of liquidity trap will be implemented through fiscal policy. And further, another set of difference between fiscal policy and monetary policy. Here also the same thing, but when they ask in section A, this particular answer is easy to write. Change in the government spending and tax is fiscal policy. Change the interest rate and money supply is monetary policy. It is set by the government. Which one? The fiscal policy. But monetary policy is set by the central bank. For fiscal policy, there won't be any target. But here the target is to control the inflationary situation. Money supply is the main thing. In case of fiscal policy, the side effect of the government budget borrowing will influence the economy. But side effect of the exchange rate and housing market will definitely influence the money supply of the economy because the monetary policy will give the side effect also. A strong political dimension to change the tax rate. This is possible through fiscal instruments. But in case of monetary instrument, most are dependent from the political process because they may say monetary measures and non-monetary measures, but it is also a part that be the government influence with that. Only the method, not the money supply. In easy words, there are two sides of the fiscal policy. One is expansionary side, other one is contraction side. When you increase the tax, definitely there will be a slowdown. When you decrease the tax, there will be a expansionary. So fiscal policy is a single tool, but it can be used in both the ways. And what are the different types of fiscal policy? As I said earlier, there are two extreme sides. One is contractory, another one expansionary. But in between these two, there is a neutral fiscal policy. The contractory fiscal policy is considered to be whenever we want to slow down the economy, the tax rate will be fixed in a very high rate. So those economic activity will be restricted and automatically the economic process will be slowed down. This is one side. Suppose when we want to increase or we have to enhance the economic activity, we can fix a very low tax rate, we can give tax holidays, all these things. It will improve the economic activity, it will speed up the economic activity. Instead of contrary or expansionary, there are some measures through fiscal. We can have a neutral policy because we have to maintain the economic activity. For that, the neutral fiscal policy will be taken into account. This is the fiscal side. Now we will see monetary side. How the monetary expansionary policy will be whenever there is enough money supply, lowering the interest rate, maintaining less reserves, slow down the economic growth. All these things are higher inflation rate. These are all the expansionary policy through monetary instruments. How to control the economic activity? We can lower the money supply, we can stop the money supply, or we can fix a very high interest rate, or we can increase the marginal requirement, or we can lower the inflation rate. By all these things we can contract the economic activities. This is in case of monetary policy. Finally, I want to compare that particular monetary policy either in expansionary or contractory. First one is easy money is an expansionary monetary policy. Tight money is a contractory policy. How to implement the easy money policy is the monetary policy will be designed to contract the effect of the recession and return of economy through full employment. This is a easy money policy. What is tight money? The same monetary policy is designed to contract. First one is counteract. Here we have to contract the inflation. When inflation rate is high, then we have to tax more in order to reduce that and the return on full employment. So based on the economic situation, whether we have to go for the easy money policy or tight money policy, this is possible through monetary policy only. With this, I am completing the class. If you have any doubt, you can ask me. This is my contact number. I have also shared the email ID.